Hi friends, my name is Rahul Jain. I'm a SEBI registered research analyst. As you may be aware, I've been talking about 40 stock series on my channel, meaning that I'm going to speak about 40 stocks in the next few weeks, and two videos are already out, part 1 and part 2. You can go and watch those videos as well. This is the third video. A lot of people have asked me to continue this series, so here it is, part 3. In this video, I'm going to speak about 3 companies, and in the previous videos, I spoke about large cap companies. In this video, I'm going to focus about one mid cap, one small cap, and one mega large company. Very interesting insights I will bring and present to you in a very succinct and short way. Okay. If you're new to my channel, request you to hit the subscribe button, like this video, and drop a thank you in the comments. It acts as a motivation to me and my team. With that, let's get this video cracking. The first stock is Global Health Limited. It is a very well-known hospital chain. You might have heard about Medanta. Okay. Now this company is a small cap company as of now. I think if you look at the rank of this company in terms of the market cap, it is at around 255. Very soon it could definitely become a mid cap company, right? Now let me give you positives, negatives, and interesting insights about this particular company. The first very good point about this company that I personally like is that this company is promoted by Dr. Naresh Tehran, okay, who is also the Chief Managing Director, Chief Cardiac Surgeon. And Mr. Tehran holds around 33% stake in this company, which have been constant in the last couple of years. If I show you the data here, if you look at the promoter stake here, it is at around 33%. And this is a very good thing, because if a promoter has a skin in the game, the company is likely to do well. Okay, now let me talk about the future growth prospect of this company. Okay, what you see on my screen is the capex plan for the next 5 years. You would have heard a lot in the news, in the media. A lot of influencers have also talked about hospital sector is fast growing sector. One of the examples is this company here, because if you look at the capex plan for the next 5 years, company is projecting around 4,500 crores of capex planned for the next 5 years. In fact, they have broken it down by the locations where the new hospitals are likely to come up. You can read this, but overall, if you ask me, is business investing and expanding? Yes, absolutely. Next 5 years, you can see the mega growth coming in terms of the hospitals. What you see here on my screen is the immediate next year sort of a forecast in terms of the bed additions. And what you note is that in FY26, around 20% of bed additions were made by this hospital chain. And next year, it is around 13.5%. So slowly, every single year, they are trying to open up new hospitals, increase the capacity of the existing hospitals. And in fact, here you can read the breakdown of the growth coming up from, for example, they have acquired land in Guwahati in Assam, Mumbai, for example, Varanasi, it is already operational. Noida hospital was operational last year in 2025, right? So a lot of expansion is what the company is doing, which is what I like in particular, because if a company is putting a lot of capex in the next 5 years, then imagine the growth in the profitability, their top line, let's say 10 years down the line. So all of this will make sense 10 years down the line when we see a lot of hospitals have come out, a lot of traffic is going in terms of the revenues and profitability. That's where the money will be made by the business, in my view. Now, if you look at the P&L of this company, you would note that up until 2021, financial year 2021, not a lot of growth was there. If you look at the top line, it was flattish. If you look at the net profits, they were not great, right? But after FY21, if you see, top line has picked up meaningfully, and the profits after tax specifically have gone very high, from 196 crore to 326 crore, 478, 481, 554. So the PAT growth has been there in the last 4 to 5 years, and because of the capex investment that is likely to happen over next 5 years, I think in the next 10 years or so, this company's PAT is likely to continue to grow at a healthy rate, is what I can see as of now. Now let me also speak about the margin profile of this company. Extremely important point. What you see on my screen is this company is operating at a EBITDA of around 25%, 23%, depending on which year you're looking at. If you see 26% in FY24, 25%. This is a very healthy EBITDA in my view. Okay. If you go and look at, for example, Apollo Hospital, their EBITDA is also very similar at around 25%, which is a very good figure to look at. If I talk about the profit before tax, it is at around 17%, 16%, as you can see. PAT profile is slightly lower to my liking. 12.8%, 12.3% is still a healthy PAT margin, but I would have loved to see around, let's say, 15%, 16% sort of a PAT margin. It is okay, it is decent, it is not that bad, but any company that you are analyzing, definitely have a look at the EBITDA margin profile, right? Have a look at the PAT margins, because if a company is operating at a 2, 3, 4, 5% PAT margin, then for whatever reason, if in a particular year their expenses go up, the company might incur losses, right? This is very, very important. Definitely have a look at the PAT margins. Now, coming to this company's debt and cash balances, have a look at my screen. The company is debt free totally, right? In fact, they're sitting on cash. As you can see here, the cash reserves as of FY26 is around 5906, okay, which is around 590 crores, right? Which is great. The company is not having any debt, okay. If you look at the ROCE, healthy ROCE 23%, right, excluding Noida and projects that they recently have done, because when they put more money into, for example, a new hospital, their ROCE will look lower. So in the next 5 years, if you see, the ROCE is likely to come down because they're going to put a lot of capex, and the returns, the profitability will not come immediately, right? So keep that in mind and don't get worried about if the ROCE drops about this company, right? Now, coming to this company's revenue making streams, heart disease is the number one, as you can see at the top, digestive number 2, cancer at number 3, but it has been growing in terms of the contribution. So all in all, from all aspects, this company looks very, very good fundamentally as of now, right? Now, one of the things that I personally do not like about this company is that their occupancy rate is on the lower side. So for example, they declared occupancy rate of their beds is at around 61, 62%. To my liking, this is on the lower side, because if I compare this with, for example, Apollo Hospital, their occupancy rate is around 67%, 68%, right? That's why Apollo trades at a premium as compared to Global Health. But definitely the capex planning that I talked about in the beginning of this particular segment, that is the key thing that we need to know. And a lot of other hospitals are also doing capex, so it's not the only company that you can go and explore. But this company is right now sitting somewhere in between the, about to become a mid-cap company. It is right now a small cap company. That's why I think the growth potential is there and the company is putting a lot of money into capex, right? Now, coming to valuations of this company as of now. So let me talk about the valuations here. Right now, the PE ratio is at around 59. Okay. Now, all hospital companies. So if I go and talk about hospital companies PE ratio, they are very, very high. Fortis at 70, Max 66, Apollo 62, right? Very, very high P's. Narayan Rudale, another company, that is trading at slightly lower PE at around 45, but Global Health is right now at around 59. And if we talk about the PE ratio, it used to trade at around 107 back in July 2025. The PE has compressed. Okay. Now these PEs are likely to remain elevated. Why? Because hospital is a sector where we are anticipating a lot of growth. Okay. A lot of hospitals are coming up. You might have heard about the hospital tourism. A lot of foreigners are coming from a lot of countries like Middle East countries, etc., to India to get treated, right? So definitely there is a growth potential in this particular sector. Whenever you are looking to invest in hospital companies, definitely look at the valuations, right? You don't buy these companies at 100 P, 90 P, 80 P. Look at some sensible Ps of around, let's say here, somewhere here, the P dropped to around 46. 45. These are very, very good valuations in my view, because this is a continuously growing sector and you're not going to find stocks at 30p or 25p in my view as of now. But this company is a very, very good company. Go and study this company in a bit more detail if you want to. It's not a buy sell recommendation by any means, but hope you enjoyed this unbiased commentary. With that, let's move to company number 2 now. Second company is from US stock market, Amazon. Very, very interesting insight that people are ignoring about Amazon. They don't know. They are only talking about Nvidias and Googles, etc. And they are not bad companies by any means, but Amazon has something very, very interesting that people are not aware of. Okay. First of all, if you look at this company's market cap, it is at around $2.64 trillion, right? It's a mega cap. We all know that. But more importantly, if you look at the key ratio, so any company that you're looking and analyzing, first thing you need to look at is what is the ROE or ROCE, right? ROE, return on equity, is at around 24%. Any business that is giving you more than 20% of ROE, it's a very, very good business. Okay, that is the first criteria that you need to look at any company, right? Now, more importantly, if I talk about the fundamentals of Amazon, you see the top line, the revenues of this company consistently have been growing, right? If I talk about the PAT here, let's come down here and look at the net income here. What you will note here is that the 2022 was a really bad year for them. But after that, if you see $30 billion of PAT, $59 billion of PAT, $77 billion of PAT. Recent couple of years, the PAT growth rate of this company has been huge. phenomenal. Okay, why this is the case? Let me walk you through that, because it's an important point that you need to understand. See, if we break down the net sales of this company, what you would note is that AWS, which is their cloud business, which is where their AI business is also hosted, around 18% of the net sales are coming from this particular segment, 59% from North America, and international 23%, which is all the grocery, marketplace business that we all order from Amazon, right? But AWS is where the interesting things are happening. Okay, if I talk about, for example, how much of the growth rate AWS business is seeing right now, so it has grown at around 28% year on year in the last quarter, and this is the highest growth rate in the last 15 quarters for AWS. Okay, and it has become a $150 billion sort of a annual run rate business. Okay, the company is doing at around what, $742 billion of annual run rate business, and out of that $150 billion is now coming from AWS. So the AWS contribution to their overall sales and profitability has been growing. More importantly, if you look at within the AWS, they also have their chips business that is growing phenomenally. That has become like a $20 billion business, and it is growing triple digit percentage from the chip business, is what people are ignoring or they don't know about it, right? A lot of people are only talking about NVIDIA. NVIDIA, no doubt, has been growing at a phenomenal rate, right? Of course, you might have your own viewpoint around AI, whether AI is in bubble or not, but Amazon is being ignored because it has not gone up the way NVIDIA has gone up, right? In terms of the stock prices, etc., right? So there is a lot of scope and room for Amazon here. Now, a couple of other points about their chip business here. So for example, they have around $225 billion of revenue commitment coming for their Trainium, which is the chip. Okay, and companies like Meta are heavily relying on these particular chips, and overall the backlog of this AWS is at around $364 billion as of Q1. Heavy backlog is what the company is sitting on. A lot of other data points that you can go and read about their chip business, their AWS business. Also, they're riding on Anthropic, right? Around $8 billion is at least they put into this business, and in exchange Anthropic committed around $100 billion into AWS for the next decade, etc. Now, of course, this is a circular financing that I've given you the funding, Anthropic, and you then put that money back in there. That concern is definitely valid, but please understand, Amazon stock price has not gone up the way Nvidia has gone up, right? For example, again, these are the aspects that you need to look at, but the bottom line is that their AWS is growing very fast. There is a good growth rate coming from there. Again, I have not talked about their grocery business because that is not giving them a lot of margin at the minute, right? The sales are not growing at, let's say, 20%, etc., right? So the main growth is coming from their AWS business. Now, is there any concern about this particular company? Yes, there is one concern, one red flag here, which is around their free cash flow. So have a look at my screen. What you see is the operating cash flow. So operationally, the company is doing well. They are generating cash. You can see clearly how the cash flow has been growing at around $113 billion to $148 billion. But because they're putting a lot of capex, right? You can see the capex investments here. The free flow of the cash is very low. And this is a dangerous situation. Investors do not like that, right? And whenever you would hear that AI is not giving returns, AI is in a bubble, right? Companies like Amazon will also get hammered down. So this is the risk that you need to be aware. It's not that there is no risk in this company. The red flag here is the free cash flow. Operational cash flow is there, but they're putting a lot of cash into the capex of the business. Now, in terms of the valuations of this company, this is where it gets interesting, right? If you look at the PE ratio, forward PE ratio of Amazon as of now at around 28. And if you look at the PEG ratio, it is at around 0.81, which is less than 1. But in my view, if I were to invest in this particular business, I would look at around a PE, forward PE of around 25, 24, right? A little bit more correction is needed in my view, but again, this is up to you. When do you want to invest? If you ever want to invest in AI, whether you want to keep completely out of AI. But as of now, forward valuations look slightly elevated to me. 28 forward P is what is right now stock is trading at. Up to you. What do you want to do? Hope this commentary around AWS business fast growth rate, that would have given you some insights, right? Now, if you want to invest in US stocks, you can go and explore Vested platform. I am heavily using it, right? A lot of data is also here. You can see here key ratios, for example. You can read fundamentals. You can look at the earnings call transcript, right? Some of the data that I showed you was from their earnings call transcript. You can read and you can gain a lot of insights about a lot of companies. There are more than 10,000 stocks, ETFs hosted on Vested. I've given you the link of Vested in the description and in the pinned comment. If you use my link, then after opening your account and depositing your first fund, you will get $10 free from Vested as a bonus. Okay. Link is in the description and in the pinned comments. Go and explore US companies as well, but of course be wary of the valuations, right? It's not that you can go and buy any company or the 7 big companies. It doesn't work like that. You will have to look at the valuations whenever you're investing, if you're investing, right? This is the company number 2. With that, let's go to stock number 3 now. Third stock that I'm going to speak about is PB Fintech Limited, famously known as Policy Bazaar insurance company. It's a mid-cap company. We all know that India is still under-penetrated when it comes to insurance, right? So there is a huge growth potential in insurance sector as such. And let me speak about the listed company, which is PB Fintech Limited, right? Now, if you go into P&L of PB Fintech, what you note is that up until FY23, the company was making losses, right? 488 crores of losses here. But in FY24, company turned PAT positive, 64 crore, then 353 crore and 670 crore, right? Now, this is an important pivotal point for PB Fintech because from losses, they became profitable and their profits are sustaining now. We can clearly see that from 64 crore, 353 crores and 670 crore. Now, one of the interesting insight that a lot of people do not know about this company is this here. What you read here is interesting. Their management talked about it very, very recently. If you look at the last 10 years of trend of claims by customers, only 5% customers claimed the insurance more than once. Okay. Next 10% customers claimed from the insurance only once, and the remaining 85% no claims whatsoever in the last 10 years. Means 85% of their customers have been paying the premium without really claiming. And what the management is saying is that it has taken us 10 years to build this customer base. That's why the point 1 that I talked about is the profitability and the losses, that the business could not be profitable on day 1. It took a lot of years. In fact, if I go back and look at 2015, they were making losses, and almost 10-15 years of losses the company has made. But since FY24, the company has started making PAT. So hope that context is very, very important, that they have taken a lot of years to build this customer base. And as a result of this, if you note here, for example, in FY26, 935 crores of their revenues have come from renewals. What is renewals? If I take a policy today from Policy Bazaar, the next year I am renewing it, right? And this gives them healthy margins. As you can read here, 80% margin, right? And this book has been growing at around 43% CAGR basis. FY22, only 222 crores of the renewals. Now it is at around 935 crores. So once they build this customer base, if the renewals continue to kick off, then the margins are likely to be much better. This is an interesting insight that I thought will be very, very important for us to understand. Now, if you look at the FY26 PAT, around 670 crores, but they're targeting at around 1000 crore of PAT next year. So the PAT sustainability can be seen here, and so far what they had been guiding around have been delivering. If you go and read their management commentary and the investors presentations, you will feel that the company has been able to hit their guidance. Okay. Now coming to what the company's margins look like. So this is a very, very interesting point that I talked about in segment 1 as well, that if the PAT margins are not great, then why are you investing in a particular company? Here, if you note, PAT margins were in negative because the company was making losses. 1.9% in FY24, 7.1% in FY25, 9.9% in FY26. So their PAT margins are not huge. Okay, please understand this point. But they have been negative and slowly now they have been expanding. Where will they go and stabilize? We don't know that. Okay, but as of now, it's not a huge PAT margin sort of a business that you need to understand. It might go up. We don't know yet. Okay. The other point that you need to know is from a debt and equity perspective, how much of debt they have, how much of debt and equity ratio is. So around 5% is debt to equity, very, very low debt. It is not material at all. In fact, they're sitting on a cash holding of around 2766 crores, maybe from the IPO proceeds, etc. Right? So from a debt perspective, I'm not concerned at all. Where is my concern? So here is one red flag, because I have to give you completely unbiased commentary about these companies. One of the red flag that I personally see is the cash flow. So in FY24, they were operationally generating positive cash flow, as you can see here, 865. But in FY25, if you look at, their cash flow was negative, operational cash flow. Okay, FY26 annual report has not yet been released, so I could not get that data, but it'll be interesting to see whether they did operationally well or not from a cash flow perspective. Any company you analyze, please make sure you're also looking at the cash flow statements. Very, very important. If a company is continuously generating good operational cash flow, then that gives them the ability to invest that operational cash flow into capex. As we saw in global health in the beginning of the video, right? They are generating heavy operational cash flow and that is going into capex, meaning company doesn't need to go and take loans, because if you're taking loans, then of course there is an interest cost, your P&L will look lower, right? A lot of things things will happen. So lower the debt, better it is. But again, it's not that I'm against the companies that are taking any debt. It's not like that. But if the debt is not there and if company is generating operational cash flow, it's a very, very good condition to be at. So this is definitely one red flag that we need to watch out for. Second one is that PV Fintech's founders have been sort of trading their stocks themselves. For example, here recently in the news, very, very recently, the founder Vijay Dahiya, he sold some stakes, right? And you can read this news here. Interestingly, when I went into the stakeholders shareholding pattern, there are no promoters in this company. Please understand this point also. Okay. Generally, I do not like the companies which are not promoter run. Here, they are not promoter run. They are FI, DIs driven. Of course, founders have the stake in the game. For example, Yashish Dahiya, right? Now, you see, June 2025, he basically sold from 4.31% to 3.57%. But again, in December 2025, he bought more shares. His stakes went up to 3.86%, right? Now he sold it. Okay. So I don't know what is going on here that he is buying and selling. Maybe he looks at the valuations. If he finds the stock is cheaper for whatever reason, then he goes and buys it. But because the founder's stakes are not constant, it definitely is a cause of worry for me. That's what I would say. Now comes the valuations of this company. And if you look at the PE ratio of this company, okay, for example, here it used to be at around 1000. Why? The company was not making any earnings, right? We talked about that. 10 years they have taken to build that book. Now slowly the PAT is going up, right? And as the PAT is growing up, you see the PE ratio is coming down, compressing. It is at around 100. But don't worry, this PE will continue to compress if they continue to make good PAT, right? So if next year their PAT goes to, let's say, 1000 crore, this PE ratio will continuously come down. Okay. So PE ratio is slightly meaningless here. Okay. Look at the price to book ratio, maybe that will give us some better view. So here, for example, price to book ratio median has been around 10, right? In the last few years, it is right now below 10, okay, 9.6, right? And highest it has gone to around 16.6. So you could take that as sort of a benchmark whenever you want to study this particular company. And of course, look for times where the valuations are not very, very high. Okay, definitely valuations is the key thing here, because in any business you go and look at, if the growth is there, which we are able to see here, future potential is there next 5 years, 10 years, but what is the valuation at which we go and accumulate the company? That is what really matters. I've talked a lot about this company, right? If you look at the DIs have been buying this company here, okay, while the FIs have been selling this company. So there is a tug of war going on between FIs and DIs, right? Again, you can go and understand their life insurance business, their health insurance business, and a lot of other things. I've not spoken about the entire business model. I've not spoken about the Paisa Bazaar as well. This is likely to do well next year as per their management. So there's a lot of insights that I've not talked about because there is a limited time. I'm trying to give you 3 companies' key insights that really matters, that gives you a long-term picture, not very short-term, quarter by quarter, what is happening in this business, etc. Hope you're enjoying these insights. Let me know if I should continue this series or not, because your likes, your comments, your subscriptions is what will indicate to me that you're liking these kind of videos. Not a lot of people are able to give you this sort of content in a nicely presented way. Hopefully you're enjoying them. So let me know in the comments, simple thank you, and also subscribe to my channel, because your subscriptions, your likes are the motivations for me and my team. I've given you the link of Vested as well. If you want to explore US stocks, definitely go and explore and check it out. I'm going to see you in my next video. Until then, keep rocking.